Inflation recently hit a fresh 40-year high, this time coming in at 7.9% year over year. This rise in prices was led obviously by food and energy, which have been hit hard recently. Janet Yellen, the Secretary of the Treasury Department, was asked about this, and number one, basically blamed it on Russia, and number two, she said, I don't expect that we see a recession as a result. And with her track record, this virtually guarantees that we're about to get a recession. Ready? Let's dive in. Think about ice cubes for a moment. Ice cubes are a really good example of what is going on right now with inflation. Now hold on a minute, just hear me out. Take an ice cube and measure the temperature. Let's say it starts out at 1 degree. You want to melt the ice cube. So you're going to start to warm up that ice cube. The ice will move from 1 degree to 2 degrees, then to 3, then to 4, and it will continue to increase in temperature all the way up to 30 degrees, 31 degrees, 32 degrees, and at this point, there has been no change in the structure of the ice cube. It is still 100% solid. The temperature has moved from 1 degree all the way up to 32 degrees. The energy has built up, but no change yet is visible or testable from the outside, unless of course you have a thermometer. But from just touching it, looking at it, feeling it, you're not going to notice any difference from 1 degree all the way up to 32 degrees. But one more degree change. The ice cube changes from 32 degrees up to 33 degrees. Instantly, it turns into liquid. It goes from solid to liquid, from ice to water with 1 degree. Now, it wasn't just that 1 degree that caused the melting. It wasn't just that 1 degree that caused the massive change. It was the buildup of energy. It was the cumulative effect of from 1 to 2 to 3 all the way up to 31, 32, then 33. You couldn't have gotten from 32 to 33 if you didn't start from 1 and build up all the way from there. This is a perfect example of what we are experiencing right now with inflation, because for years, following the financial crisis, with all of the balance sheet expansion by the Federal Reserve, with the years of interest rates way below what they should have been, with the years of deficit spending, with the years of an artificial expansion of the money supply through an expansion of credit, through the credit bubble exploding over the last 12 years or so, we have seen a buildup of energy, and we did not experience what we're experiencing now. There was some inflation, certainly a little bit higher than what the official numbers were telling us inflation was, but it was not anything like what we are experiencing now. And the point is that it takes a long time for things to build up. And it doesn't mean that everything that they were doing beforehand was peachy. All it means is that it was building up energy. And eventually, it's going to tip over, it's going to spill over, and it's going to cause a phase change. You're going to end up having it spill over and start to see the results from the years of buildup. Not just from the last 1 year, not just from the last 3 years, from the last 13 years, and everything prior to that. Looking into the details of the inflation that we are experiencing right now, inflation was up 7.9% year over year for February. That means prices on average, given how the CPI is measured, which is most likely severely understated, measures that prices on average rose by 7.9%. Now, that is including food and energy, and we know they always like to strip out food and energy because those are the things that people need the most and will always spend the money on, so they like to strip those out and look at core inflation, which also hit a fresh 40-year record at 6.4%. Now, the real kicker here, which every month this is glossed over by mainstream media, but inflation has not hit wages as much recently as it was a year ago, 2 years ago. We've seen a slowdown in wages. Wages only rose 5.1% year over year. That means, on average, people's earnings went up by 5%, but their cost of living went up by 8%. So your salary goes from $100,000 to $105,000. You feel good, you got a raise, But wait, your cost of living went up to $108,000. Are you better off? No, you're $3,000 short. Now, obviously, this is an average, and averages hide extremes. As Nassim Taleb likes to point out, averages in temperatures. Let's say your body is 100 degrees where it's right about where it's supposed to be, but that's an average because your toes are 50 and your head is 150, you're dead. And so this rise in wages and the rise in the cost of living, they're averages, but for some people, it's much worse. Their cost of living has risen dramatically compared to their wages, and for some people, it's a lot better. Their wages and their earnings have risen dramatically compared to their rise in their cost of living, which will definitely lead to problems down the road. Cultural, class warfare, populism, resentment between the haves and the have-nots. Now, Janet Yellen, the Treasury Secretary, she used to be the chair of the Federal Reserve. She was asked about this inflation, and she said, I don't see any signs of a recession as a result of this. She said, we've seen inflation pressures for a while now. The situation with Russia and Ukraine is making things much worse. There's a lot of uncertainty, but I don't see this bleeding over into a recession. And like I said earlier, with her track record, this virtually guarantees we will have a recession soon. Now, this time she didn't want to make another inflation prediction, but just about 1 month ago, she was saying that inflation, year-over-year inflation in the United States, would drop to about 3% by the end of the year. And it looks like she's not sticking too hard to that prediction as of right now. And to top it off, she said that she has confidence in the Federal Reserve's ability to tame inflation. And here's the thing about that. That statement is technically true. At any point that the Federal Reserve wants to, they can stop inflation in its tracks. They can sell 100% of the assets off their balance sheet. They can let go of their control of interest rates, let the free market determine what interest rates are. They'll go through the roof, and as a result of all of that money leaving the system, as a result of all that money getting sucked out of the system, paying off debt being defaulted on, the money supply drying up, everybody going into risk-off mode, saving, not spending, immediately inflation would be halted in its tracks. Everybody would be plunged into a recession, plunged into pain. Everybody would go into lockdown mode, and we would see very, very, very sharp pain. Unemployment everywhere, a drop in purchasing power across the board, a drastic and swift and severe drop in real goods and services. The markets would crash. You'd see companies go bankrupt. But guess what? That's baked into the cake already. That deleveraging will happen inevitably one way or the other. It is much better to take that free market approach, experience the pain, take the consequences of the last 2 years, 10 years, 20 years of bad policy that has been making the problem worse and extending it and making it inevitably last longer, and instead take it on the chin and realize we have to take responsibility. Even if it's not our fault, there's a difference between fault and responsibility. It's not our fault. Like, it's not your fault. It's not my fault we're in this position, but it's our responsibility to take the burden and say, hey, we can make this better. We can take it on the chin and we can make it better moving forward and we can rebuild. And all these companies that go bankrupt, they're going to lose their assets, and there are going to be companies that survive, and they're going to absorb the real wealth, the real goods and services, the physical stuff that survives. All the airplanes from the airline companies that go bankrupt, they'll be purchased at bankrupt prices, at discount prices, pennies on the dollar by the surviving ones. And going forward then, nobody will take those extra risks because they'll realize there's no bailout coming. Everybody will save. Nobody will over leverage because they know there's actually a risk of failure. And on the back of savings, we can rebuild with massive growth, massive strength, real innovation, and real growth, not on the back of a credit bubble that is inevitably going to crash at some point and pop and result in us stealing wealth from the future. Instead, we can start to build wealth from a solid foundation and create wealth for the future instead. But that's not going to happen, and that's not what the Federal Reserve is going to do. That's not what the Federal Reserve has ever done. In fact, in the Great Depression, their biggest regret Every official, every person that works at the Federal Reserve says the biggest mistake the Federal Reserve ever made was not combating deflation hard enough during the Great Depression. And that is the guideline that they have moving forward. They are far more afraid of deflation than they are of inflation, and they will always err on the side of being too easy, not being too tight. And as soon as the bond markets, as soon as the fixed income markets, as soon as the financial institutions cannot handle the weight of the Federal Reserve's balance sheet no longer expanding, maybe declining a little bit, interest rates getting a little bit too high, and institutions start to fall over, at that moment, the Federal Reserve will reverse course and err on the side of easing an inflationary policy and not risk a collapse, a deflationary collapse, even though it would be better long term. As always, I really appreciate you guys. Thank you so much for watching.